I'm Michelle Nowfel, Head of Distribution. I want to welcome you to our City Different Investments third quarter roundtable webinar. From our investment team, we have fixed income co-portfolio managers, Ryon and Sweta Singh. Portfolio managers, Rob McDonald and Connor Brown from our domestic equity team. And joining us from Poland is our global portfolio manager, Walden. As a reminder, if you have any questions, please type them into the comments box and we will address them during the Q&A session. Let's get started with Sweta. Sweta will begin by reviewing the third quarter and discussing the government shutdown.
Thanks, Michelle. The biggest theme for the Fed and the fixed income market alike for Q3 was the slack in the labor market. The U.S. labor market showed signs of slowing down in third quarter. An August sharp decline in job growth, along with the big revisions that we saw for earlier in the year, gave rise to a slight increase in unemployment rate, and it suggested that the slack was gradually emerging in the economy. The slowdown was enough for the Federal Reserve to take a more accommodative approach. So when it came to its September 16th, 17th meeting, the FOMC decreased federal funds rate by 25 basis points, bringing down the target rate to 4.25, but more importantly, signaling a shift towards easing. And fast forward to October, which admittedly is Q4, we saw another incremental 25 basis points rate cut, bringing the target Fed funds rate to 3.75 and 4%, but in that band. On the macro side, in Q3, although inflation remains somewhat high, policymakers highlighted the risk environment had changed with the weakening labor market and rising downside to employment that had taken priority. The Fed has also acknowledged that the ongoing inflation pressures related to tariff adjustments, although they are important, but for right now, somewhat less significant than expected. However, both the Fed and the markets are wanting for data right now, as the government shutdown is almost a month old. And if it lasts to the end of this week, it will be the longest lasting. There were rumors over the weekend, however, that a planned end to the shutdown would be Wednesday or Thursday of this week. And it's TBD. Let's see how the week plays out.
Chris, you recently wrote a blog describing the Fed as being between a rock and a hard place. Could you elaborate on that and explain how you see policy unfolding from here?
Yes, I can. And as Sweta mentioned, she kind of outlined why the Fed's between a rock and a hard place. It has a dual mandate. It's supposed to promote employment and stable prices, well, as Sweta mentioned. And as we've seen in the headlines, a number of significant layoff announcements have come about. Employment looks to be under a little bit of strain, but we still don't know what the complete impact of the tariffs will be because they continually change. So, higher unemployment rates would mean that the Fed would lower rates, but higher inflation means they would increase rates. And we saw that kind of division in the recent Fed statements and the speech by Chairman Powell. Okay, they lowered rates 25 basis points on Wednesday, but you had two dissensions, one calling for rates to remain unchanged, one calling for a higher cut in rates. Following that, we had a number of Fed governors come out with statements saying, two of them came out and said we should maintain current levels of interest rates and not change. And Chris Waller came out and said, I think we should be lowering rates. So there is dissension on the board. And in that light, Chairman Powell pretty much took away the punch bowl, or suggested he was going to take away the punch bowl at the December meeting, saying that a rate cut in December would have to be under consideration. It's not a sure thing. That kind of grabbed the market and shook it a little bit, because the Friday before the Fed meeting, the implied probabilities of a Fed rate cut in December were over 100%, like 105%. The Friday following the Fed meeting, that implied probability had dropped by 35%. So it's now down in the high 60s. And So fiscal policy is not the only thing that's causing some concerns. About 2 weeks ago, two regional banks announced that they had some problems on their loan book. They attributed these problems to fraud. And if I was in their shoes, I would be doing the same thing, because you can't analyze fraud, but you can analyze lax lending standards. So this is where we stand on the fixed income markets. I'll turn everything back over to Sweta at this point.
Yeah, thanks, Chris. So I'll just give a really high level look back or recap on the three segments of the market that we play in or invest in: the municipal market, the treasury market, and the investment grade credit market. I'll start first with the Muni market. So Muni market ended Q3 with a flatter yield curve. However, things were not always flat in Q3 on the curve side for munis. Actually, August of this year was the most pronounced steepness in the 2/10 part of the curve, at almost a 1% slope. And to give you an idea, this on an average is 1.5% for the Muni market. However, really the curve peaked in terms of slope in August and then came down or flattened in September. We were at a point in August where Chris and I were contemplating, moving down the curve in terms of both putting some more duration or thinking about the optimal curve allocation. However, that is on pause because the curve has flattened. Moving on to the second theme in the Muni market that's pretty pronounced as well is issuance for the year. As of end of Q3, the issuance number was 415 billion. Again, to give you an idea, this is more than full year totals for 2018, 2022, 2023. So really robust issuance, and investor appetite matched it, toe to toe. So the supply was well absorbed in the Muni market. Jumping ahead to Muni credit. Muni credit remains really strong. The fundamental profile for state and local governments, really strong. They entered the year on strong reserve levels. Tax revenue growth has been good. However, what we are seeing is the emergence of some risk pockets. We are cautious with regards to healthcare sector, higher ed sector, and we do have a bias towards general obligation for now. And states are also starting to map out results of the provisions from One Big Beautiful Bill Act, which will increase deficits and significant gaps in Medicare, Medicaid payments. However, the states enter this new tax landscape with strong reserves that are at multi-year high. So something to watch out for, but right now municipal credit has a very strong profile. Okay, I'll jump really quickly into the treasury market. So Q3, the US Treasury yield curve to some extent mimicked the Muni yield curve. Nowhere was it as steep as the Muni yield curve, but it did peak and then flattened out for Q3. And it was largely driven by concerns surrounding the Fed's independence. That market thought, could that be compromised? There was, undermining market trust and long-term stability, commitment to controlling inflation. So the 2/10 spreads tightened to 52 basis points from Q2 at 55 basis points. So really modest flattening there. Now, on the supply side, Muni, just like Munis, actually, Treasury supply dynamic is more on steroids, frankly. It revealed heavy supply environment driven by sizable fiscal deficit, substantial rollover requirement for Treasuries. However, Treasury auctions were really well absorbed, and it was largely buoyed by strong demand from money market funds, banks, international investors, given the heightened short-term yield environment. Okay, our last segment that I'll cover on the fixed income side is credit, or IG, investment grade credit landscape. Q3 credit fundamentals for most corporations really remained stable and also showed modest improvements supported by strong earnings. However, we do remain vigilant about event risk in this space, which has resurfaced and driven largely by the surge in the M&A environment. Within investment grade, fundamentals remain supportive. Like I mentioned, strong earnings, manageable leverage for now, and a rebound in issuance, which has been strongly supported by high investor demand. So narrow credit spreads, but sustained inflows in high quality fixed income continues to indicate investor confidence in the sector. And I'll pass it on to Chris to briefly touch on Q4 outlook.
So towards the end of Q3, we were thinking of changing our curve allocations. As an active manager of laddered portfolios, we had been focused on the shorter end of our SMA's investment universes because of the flatness of the yield curve. We anticipated changing that in August as the curve steepened, but today we're not changing. We're staying focused on overweighting the short end of our SMA's investment universes because in both markets, treasuries and munis, if you own a 5-year security, you're actually earning about 90% of a 10-year security's yield. That's a value argument we're just not going to fight. Thank you.
Thank you, Chris and Sweta. Let's move over to our global team. Vin, Chris recently wrote a blog, Other Signs of the Apocalypse, noting that he is seeing a version of the hidden leverage of the housing bubble in today's AI bubble. What do you think about the current equity environment? And are you worried about any parallels with 2008?
Michelle, thank you for the question. I would say, look, it's a good question, and that there's not an elegant, neat answer. And certainly there are areas we've had a great, just to acknowledge the facts. We've all had a huge run in equities in general for the last many years, but again in the last few years, and the valuations are above historical averages, and enthusiasm seems pretty bullish in a number of ways. And for AI in particular, almost everything related to AI has been quite successful, and some of it does look bubbly. So I would say, as it stands today, a big difference versus with today's environment versus some of these precedents that come to mind, and especially the TMT bubble, that I remember well, that we lived through 25 years ago. The big companies today, the leading companies that capture a lot of the capital and a lot of the media attention, are just a different set of companies, and structurally very different than those businesses from 25 years ago. So today, the big companies, and most of them have just reported recently, incidentally. So we have a very current health report there. But Google, Meta / Facebook, Apple, those were not the leading companies back in the year 2000. So these companies today have a few merits going for them that stand out in sharp contrast to 25 years ago. These are very, very well established, very profitable businesses with very high profit margins. Meta, for instance, as most people know, EBIT margin over 40%. Apple, very profitable. Google, very profitable. But also they're service oriented, and that they're providing an ongoing service that most people need or want regularly, almost every day. So it's a much more stable, recurring type of business model. In contrast, you do a quick Google search and see who was the companies that were leading the market. Back then, a lot of them were hardware companies. A lot of them were not recurring, not sustainable. Just to jog your memory, Nokia, Sun Microsystems, Intel, AOL. Remember that company? Those companies didn't have staying power, and even at the time, you could observe, they didn't have nearly the margins of today's leaders. They didn't have nearly the balance sheet strength. They didn't have nearly the recurring, service element that's really intrinsic to their business model. So I think there are some parallels, but they're limited. And overall, I think the conclusion is, pretty sanguine with respect to where we are today. Of course, these companies that I'm describing that are leading the market today deserve a much higher multiple and a much higher valuation than did the leading companies 10, 20, 30 years ago. With respect to acknowledging some of the exuberance, and I would say the excess, that it's also true, and I wrote about this in our quarterly commentary that we just published. There seem to be some extreme cases, nonetheless, not among the leading companies, but in the small and mid cap space. There's a lot of companies that have unproven business models with limited revenue or no revenue, and yet multi-billion dollar valuations. That looks excessive to me. That's where we're not investing. Our team is very, very busy and enthusiastic about the landscape right now, and we're deliberately avoiding sort of that cohort, if you will, of companies that look more speculative.
Great, thank you. Then with the dollar weakening, what are your thoughts on investing internationally? How has currency movement impacted your portfolio positioning?
Yeah, you're singing my song now. If you want to talk about currency weakness and the merits of investing internationally, we've been investing internationally for all my career, and in general, you could say it's been a headwind in that U.S. markets have been more popular and have done better overall. But for us as bottom-up opportunistic investors in the global context, it's all been fine. We've done well, and now perhaps we're getting an additional tailwind with U.S. dollar weakening. We'd say bring it on. That could be a nice little sweetener in the equation for us. But we're still overall very bottom up focused, thinking about attractive industries, attractive companies within those industries, and of course that leads us to international considerations, an international mix in our portfolio. So if you want the best companies in certain sectors, you must invest internationally. We've talked a little bit about this in the past calls, but some recent reminders in the technology space. Some of the best semiconductor companies and semiconductor manufacturing companies are non-U.S. companies. Some of the best companies in shipping and logistics, where we're very active, and we've been very fortunate in that space the last few years. And many of the best companies there are also non-U.S. companies, and of course commodities that we talk about quite regularly. Most, I would say, of the leading commodity companies and the best opportunities are not found in the United States. So those are all great facts as we consider the global landscape, and we're sort of built in terms of the city different global investment portfolios. It sounds like a cliche, but really we're built for this.
Thank you, Ben. Let's hear from our domestic team. Rob, we've seen a sharp rally in small caps alongside growing confidence in Fed easing. How much of this move is truly about fundamentals versus liquidity and rate expectations? What happens if those expectations shift?
Yeah, good question. So in the large cap world, everyone is, AI is the center of attention and it gets a lot of press. But under the covers, in the small cap world, there's been a rally going on since Liberation Day, and it's been low quality stocks. And so Empirical Research Partners did a great study just recently about this. And so if you look at small caps with lots of leverage or small caps that are really fast growing and unprofitable, they've done really well. And to explain that, there is rational sense behind it, because as with rates going down or the expectation of further rate cuts, small cap stocks, they have more leverage, and they have more variable rate debt. And so as the rates come down, you're going to see a bigger impact on interest expense. So more free cash flow goes to the bottom line for these businesses. So there's more leverage to that rate cut. And then also the unprofitable businesses that are fast growing, you can think of them as really long duration assets. So lots of cash flow way out in the future. And so as your discount rate declines, those businesses will go up in value a lot more. So that while those businesses have done really well, the stable, low beta, high free cash flow businesses have underperformed. So their stocks tend to be less exciting. This is an area that is interesting to us. We're spending some time on trying to hopefully find another investment for the portfolio. So you can think of consumer staples, some healthcare businesses. These are, they aren't super high growers, but they have reasonable margins. They're generating lots of cash, and the valuation's pretty reasonable. So hopefully, in coming quarters, we'll find something interesting here to improve the portfolio.
Great. Thank you, Rob. So at this time, we'd like to open it up to questions. Great. Thank you, Rob. So at this time, we'd like to open it up to questions. You can type your question into the Q&A box. And we have a question in here right now. So first question is for our fixed income managers. Are bonds still attractive? Do they still make sense in a rate cutting cycle?
Yes, the bonds are still attractive. And what we can see is when they talk about a rate cutting cycle, we must remember that the Fed only controls short-term rates. Okay, the difference between short-term rates and long-term rates is very narrow at this point in time. If risk vectors grow, concern about inflation, things like that, you'll find the curve will steepen. Long-term rates will go higher, short-term rates will be low. That's a very attractive environment. With what we're doing with our focus on the shorter end of the municipal and treasury bond markets, that we are set up for that steepening, so that as short-term rates go down, our overweight to the shorter portion of the SMA universes, they will benefit. And then as we see rates rise, and in the longer end, we will be able to take those proceeds that are maturing and invest them out longer at attractive rates. And in the current environment right now, we're pretty fair compared to where inflation is, but we still don't have a good read on where inflation is with the government shutdown.
Great. Thank you. Thank you so much for participating in our webinar. We have lots of exciting things happening here at City Different. If you could please visit our YouTube channel. We've posted a lot of new videos, both from Vin and our fixed income managers. So please check it out. And we look forward to you all joining us next quarter. Thanks so much.